Both stock and bond investors, I think, have to recognize, Maria, that returns over the past 30 years have been significantly influenced by lower yields. The lower the yield, the higher the price. It sort of works like a teeter-totter up and down. And to the extent that yields cannot be compressed much more, then total returns will be much less. And for bonds, to me, that means 3 to 4% over a long period of time. For stocks, perhaps 5 to 6%. But when you floor interest rates, basically you cap asset prices at a certain premium.
And how much of the QE, the quantitative easing, the liquidity the markets have absorbed now with the Fed is in that? I mean, what would those returns be like if the Fed wasn't in the markets right now?
Well, they wouldn't be as high, Bill. And I think both in the bond market and the stock market. Bonds are up 5 to 6% this year. Total return fund for Pimco is up close to 10. But, absent quantitative easing, absent the Fed buying the long-term Treasury and the 10-year Treasury and the 5-year Treasury and holding, Fed funds basically at 25 basis points, then even the Fed admits that interest rates would be 50 to 100 basis points higher, which means prices would be, perhaps 4 to 6% lower. So yes, the Fed is significantly influencing the bubbling of both bonds and stocks.